A couple more minutes to good morning. Welcome everyone to the fifth workshop for the CAREC Innovation Network, and these are kind of like online webinars that we try to get experts from the ecosystem, talking about ecosystem development. We're trying to get a lot of experts who can do some capacity building sessions with the ecosystem partners as well as startups. And I think one of the needs that has been highlighted and the requests we keep getting for is to talk about fundraising and VCs who can, come and give some tips and tricks on how really, given the kind of economic situation world over is going. So today we have Robin Butler with us, who is the one of the founders and head of impact at Sturgeon Capital. And he has vast experience having lived in different emerging markets, as well as with their portfolio companies. They've been working in the emerging market space. And I'd like to welcome Robin and thank you for making time for us today. And I'd like to hand over to you to take the session from here on.
Thank you very much, Eric, and thank you everyone who's taken the time to join today. It is kind of pleasure to meet. We virtually recognize some of the names in the attendee list and a few others that I haven't come across before. I'll share the screen and then I'll give a quick introduction to Sturgeon Capital and what we are doing. Hopefully you guys can see the screen. Let me know if there's any issues.
No, we can see the screen. It's perfectly fine.
Brilliant. Okay. Let me start with a quick introduction to Sturgeon Capital. So Sturgeon is a London-based VC investing in emerging markets with a core focus on Central Asia, the Caucasus, and South Asia. South Asia being Pakistan and Bangladesh. We typically invest at seed, pre-series A, and occasionally at Series A with check sizes of 500K up to 2 million. And our core focus is on B2B software, fintech, and marketplaces, although we look opportunistically at other deals. So now you kind of know, if you haven't come across us before, you know what we do. Myself, I'm one of the partners here, and as here said, the head of impact as well. In terms of kind of where we're present, we have now 22 portfolio companies, direct portfolio companies, as well as another 6 through a separate fund in 8 countries. So Ukraine, Georgia, Uzbekistan, Kazakhstan, Egypt, UAE, Pakistan, and Bangladesh. And we're actively investing at the moment from our second fund. So that's a kind of a brief introduction, give you a bit more context on Sturgeon Capital itself. But I was asked today to speak a little bit about kind of how startups can raise money in emerging markets today. And I thought I'd start with a kind of cheap joke around a sort of funding winter, or that winter has come for a lot of founders who maybe enjoyed in 2020 or 2021 the ability to raise money in emerging markets in ways that they hadn't previously been able to when the supply of capital had been very limited. However, that sort of that summer of plentiful capital has gone away. I mean, it's gone globally, but it's particularly the amount of funding available in emerging markets has significantly reduced. I think Pakistan's a very good case of one which had a very good 2020 and 2021. 2022 and 2023 has seen a marked drop off. And if we actually look at kind of Central Asia, interestingly, was a market that never saw quite the same boom in funding. So has not necessarily fallen as far as some of these some other countries have. But it is undoubtedly, and every founder on this call will know, a very difficult job to raise money at any time in emerging markets, but especially at the moment when the opportunities for investors. And this, maybe the first thing to say is that for most international investors, they have a choice. They don't have to invest in emerging markets. Investing in emerging markets inherently comes with greater risk, which must be compensated for by higher returns. However, if they can invest in more developed markets where they don't face the same esoteric and idiosyncratic risks, whether that's political or economic, and they can generate a return which is comparable, if not superior, then there's very little incentive for that money to flow flow into emerging markets. So that's the kind of the challenge that ultimately you are up against as a founder at the moment. That the competition for investors' capital has increased as returns have increased in other asset classes in more stable and developed markets. So I wanted to kind of run through, and there's not a huge amount of content. This is about as good as it gets in this presentation in terms of what's actually going to be on the screen. But I wanted to run through a kind of series of points which we've kind of discussed internally. As I said, we have 18 portfolio companies. So we are regularly fundraising. Some are fundraising at the moment. So we're seeing these challenges firsthand. We've seen them over the last 5 or 6 years, how they've evolved with time. And so hopefully this is kind of interesting, whether you're a founder or an investor or an ecosystem builder, to hear from firsthand experience what we think, how you can increase the probability or the likelihood of actually being able to raise capital at the moment. So I'll run through these in order, and sort of flesh them out a bit. My idea is to speak not to speak for too long, because I don't think the sound of my voice is the most interesting thing. I think the most interesting thing is actually the questions that come from you. So hopefully we'll have plenty of time for that. If you think of things, I don't know if you can put them in the chat along the way, but we'll try and go through whatever questions you have. So kicking off from the beginning, this idea that for you as a founder, you need to understand that fundraising is a process that requires time and budget allocated to it. It is not something that you should undertake lightly or in an ad hoc fashion. If you are multiple founders, my advice would be that one of you is the one who is designated as leading the fundraising, and that you're aware that for the rest of the team, that's going to mean picking up some of that person's responsibilities and duties for however long it takes to fundraise, because you really need to build a system of not only kind of who are the VCs you'll approach, how will you approach them, how will you pitch yourself, how will you follow up, how will you handle the due diligence if you get to that stage, in terms of the questions, and budget as well, in that you may well end up having to spend money in terms of traveling to meet investors, putting together materials, potentially on the sort of legal side if you have any issues that you need to sort out internally beforehand. I think if you come at it understanding that it is a job, it is going to be pretty much a full-time job for one of the founders. If you are multiple, or if you are the only founder, then it's going to be a full-time job alongside the full-time job of being the founder and running the business. Then at least you're in the right mindset, you're in the right approach to tackle what is a difficult thing to do. The second point I'd make, and what kind of ties in a bit to that first one around it being a process, is before you start going out to investors, make sure you've actually done your due diligence on them. I'm sure any of you who have raised money, you're well aware of the kind of volume of questions and information that will be asked of you by an investor if you get to the due diligence stage. But you should be doing the same before you approach them, because there are a lot of VCs in the world, there are a lot of angel investors in the world, there are a lot of alternative sources of capital, and usually they have a mandate, they have a strategy around which they're investing. Some people get to invest in whatever they want, and that's kind of lucky for them, but most people have a strategy and a mandate. And make sure before you put the effort of finding a connection to them, reaching out to them, that it's actually relevant for them. I mean, I probably get half a dozen pitches a week from companies that are never going to be of interest to us. Like, I'm sure they're cool, they're interesting, I'm sure the founders are doing a great job, but it'll be like a German Web3 company. That's that's irrelevant for us. It's not even, no matter how interesting it is, how impressive the founder is, it's not relevant. So that founder, that individual has wasted their time. To be honest, wasted my time as well, getting in touch through whatever means it is. But if you take the time to actually figure out, okay, who is the investor, what is their strategy, what is their mandate, maybe who are their kind of portfolio companies, can we see kind of relevance in terms of their experiences and their networks, their skills, of why they would be a good investor for you as a company, then you're kind of, again, you've probably filtered out 90% of all the investors in the world for whom you're never going to be relevant. But actually those 10% who are relevant, you can then, within the context of that process and sort of the time and budget you have, actually be much more focused, and I think significantly increase the probability of converting one to several of those investors into being an investor in your company. Now, having kind of, and this, the point 2 and 3 are all kind of tied together, but point 2 and 3, I think, are tied together in terms of you being able to clearly articulate the opportunity set that you are tackling, you are targeting, and why you are the right people, you and your team are the right people to be tackling it. Because, and this is a slightly pretentious way of saying it, but when you first start speaking to an investor, there is a complete information asymmetry between what you know about your business and what they know. So you, on day one, you know 100% of your business. You're living and breathing this thing, whatever it is you're building. That investor, while they might know the business model, they might know the market, they don't actually know anything about you. And that's kind of what the due diligence process is. But really, you have, on that kind of, if you like, initial call or that initial meeting, you have a pretty short window of opportunity to articulate yourself, to be very clear about who you are, what you're doing, why you're doing it. And so it's really taking the time in before you go out to investors. So once you figured out, and this will help you in understanding which investors are the right investors, if you're very clear on what you're doing and why you're doing it, you can then better understand, okay, well, I think these investors, because I can see from their portfolio companies, are the right kind of investors for me. So by clearly articulating that internally and then being able to present it clearly, you're really telling investors why they should be investing in you. Like that's ultimately what you need to convince them, that of the opportunity set of tens or hundreds or thousands of companies that they could and would and probably do look at on an annual basis, you are the one for their limited supply of capital that they should be investing in. Because that's the thing for an investor. Like no VC sits on an infinite supply of capital. We have our own portfolio construction and allocation approach, and you need to convince us that you are the right opportunity among others, because you are competing with other companies for capital from investors. And all of this kind of articulation and due diligence on investors beforehand, that's how you that's how you kind of at that early stage kind of make yourself as investable as possible. The next point number 4, is something which has changed since a couple of years ago. A couple of years ago, you were pitching to investors, you spoke about growth. You spoke about large addressable markets, hyperscaling, all this sort of thing. Now, for the majority of businesses, what investors are sort of caring about is, what they've discovered is this idea of sort of unit economics and profitability and sort of path to break even, which I don't know, I think there is a difference between emerging markets like Central Asia and more developed markets in the US, UK, where, because in the US, there is more capital available. People built businesses for growth, not for the business model necessarily. The reality in Central Asia is, because there's never really been much money, most companies have built with profitability and break even in mind, because they didn't have the luxury of having more capital available to them. But the importance of emphasizing that in your pitch and in your conversations with investors has gone up significantly. what they really want to see. And I think if you can articulate, and it depends what stage you're at, but if you're somewhere between sort of say a seed and Series A round, if you can demonstrate how with whatever money you're raising, whether it's $1 million or 5 million or 500K, if you can say, basically say, look, there is a scenario where this is the last round of funding I have to raise. With this money, I can get to a scale and a business model where if I need to, I can be break even and just grow sustainably. Like it's not going to be that maybe 15-20% month over month growth, but I can grow at 5% month over month profitably. What that means is you no longer are going to have to raise. You're not forced to raise in negative situations like we're in now, where there's less funding available, valuations aren't as good, so dilution for you as a founder and for me as an investor is greater. But if you get to a position of sort of profitability and break even, you're not forced to raise in that difficult scenario. You can wait until you find the right investor at the right valuation to provide you with true growth capital. At that point, any money you raise, you'll be like, yes, I'll invest in sales, I'll invest in marketing and customer acquisition, and it becomes pure growth. And for me as an investor today, if I know that that long-term funding risk is significantly reduced by the check that I'm writing today, that makes you a much more attractive business because it reduces that sort of failure, like all-out failure risk in the long term. And it also will likely mean I get diluted less over your subsequent funding rounds, therefore meaning my returns will be higher. So that's really why, and as I said at the beginning, like for emerging market startups, this sort of break even or well, the opposite, that sort of hyper scaling model has rarely been the one that people have pursued because it's been very difficult to get the money to do that. So profitability has been more at the core of the kind of your sort of approach to building businesses. But just to really emphasize that needs to be part of any conversation you're having with investors. And it's not to say you have to get there with this round. Maybe you're a pre-seed company. There's not an expectation at that point that you will absolutely get there before you raise your seed round. But to understand, okay, if I raise 500K today, in 12 months time, I will want to raise another 1.5 million. And I believe with that, I can get this business to a point where if I need to be, I can be break even. If I have money, I will grow. If I don't have money, I can be break even. That is a very compelling pitch for VCs. Okay. Point number 5, try and get warm introductions to VCs. So you've gone through point number 2, you figured out, look, these are the investors that I like. They have the right experience, expertise. I think they can really add value for me. Now, how do I actually go about reaching out to them? Now, one option is you try and get in touch with analysts, associates, partners, whatever, through their website, through their LinkedIn. But I mean, look, I'm going to be honest, like a lot of people get in touch through LinkedIn. It's very difficult in that short message. Oh, sorry, go back. In that short message to convey or to really sell yourself. If you are going to try and do that, if you are going to try the cold outreach, don't just send the generic message to everyone, because to be honest, it's going to get ignored. If you're going to cold outreach to a VC that you think is relevant for you, personalize that email or that message around the specific individual you're reaching out to. So it's on LinkedIn. Like it's probably got, you can probably find out which portfolio companies they led the investment on. Maybe they're on the board. Mention those companies. Say maybe how you think what you're doing is similar to them or relevant to them, or you'd like to learn from them, or you maybe have questions about them. And by personalizing it, I'm going, oh, this founder's actually done some research. They've actually looked at us. They actually think we're a good investor for them. And that's probably the only way you can make those kind of cold outreaches work. Generic messages, I get lots of them. Usually these are the irrelevant ones that don't fit our mandate, but sometimes maybe it's kind of in mandate, but it's just difficult to get excited. The reality is the best way is through a warm introduction. Now that could be through an ecosystem player, a founder, another investor. It doesn't really matter who it comes from. Well, it does matter who it comes from. The closer the connection between that VC and you, and the person who's introducing you, the better. But if one of our portfolio founders sends me a message and says, Robin, I think you should speak to so-and-so. Really interested in what they're doing. I think you'll like it. Obviously you like us, whatever. I will take that call. Probably the people I respect most are the founders that we're invested in. So I will absolutely take that call. Now, maybe you don't have a direct connection to one of our founders, but you know someone who works there, and you like take the time. It's worth investing in getting that warm introduction. Because again, if you've narrowed it down to these investors that you think are right, and you can clearly articulate your opportunity, this is all just increasing that probability of getting a sort of a proper first meeting, of coming into that meeting well prepared. And that I'm, as well as an investor, coming in with sort of positive inclinations already. And look, the cold outreach does work. One of our portfolio companies in Pakistan, a business called Trucker, the founder got in touch with me through LinkedIn. Like, it does work sometimes, but I wouldn't say it's as, like, the conversion rate is much lower. But warm introduction, you significantly increase your conversion rate to meeting, and then from there on, it's kind of up to you and the VCs. Speaking about that first meeting, it is extremely unlikely, I think, unlikely if not extremely unlikely, that an investor will write a check, an investment in you after the first meeting. Sometimes you'll get lucky, whether it's maybe an angel investor, or a couple of years ago, investors were writing checks after 30-minute calls. The reality is, chances are, if an investor's doing that, they don't fully understand what you're doing, but that's maybe they do. Maybe they're smarter than I am. But what really, I think the way to approach it is, when you're approaching a VC, understand that it's going to take time for them to get comfortable with you, because you can tell them everything in the world, you can promise them everything in the world, but they really kind of need to see evidence of that. And the best way, okay, you can go through data rooms, you can show them whatever track record, but really the best way is they've met you already, and over 6 months, you send them regular updates. And that's like a simple thing. It's an email, it's a monthly email, bullet points, highlights, lowlights, key things you're working on, and some KPIs. If you do that, having met a VC, pitch them what you're doing, they go, okay, sounds interesting, maybe it's a bit early or not right for me now. You send those regular updates, you significantly increase the likelihood of that VC, remembering who you are, because it's nothing personal, but speak to lots of founders on a regular basis. You're gonna forget exactly what you're doing, no matter how impressive it is, unless you send those regular updates. Those regular updates, they keep you top of mind. And if you then come back 6 months later and say, so, okay, look, we're raising again, like we're still raising, or maybe we raised a bit before and now we're doing a proper round. And I have that kind of track record of information, and I see it be like, yeah, I've seen you guys are doing really well. Like, I've seen how you've grown revenues, customers, launched new products, this sort of thing. So building that relationship over time, that trust, that connection, whatever you want. I don't want to make it sound too romantic here, but like that building that connection with a VC. So it just makes it easier for them to write a check and to make an investment in you, if that relationship is something that's gone on for longer than the sort of just the month after first speaking. Moving on, and this kind of ties into your pitch and articulating the opportunity set. How you articulate the opportunity set and that sort of initial pitch is what really gets you in the room. In my mind, what converts investors is the data and the numbers that underlie that vision you have. Now, okay, at pre-seed, it's different. Yeah, you don't have numbers, that's fine. You should have a good idea of potential numbers, in theory, what the business model will look like. These sorts of things, but like pre-seed is different. Once you have traction, once you have metrics and KPIs, you need to know them like the back of your hand. Because if you, as an investor, there is sort of no greater turn-off, I think, than a founder who you say, oh, what was your revenue last month? And they go, oh, I'm not sure, I haven't seen last month's numbers. And it's like a seed stage company. You're not big enough to not know what those numbers are. You should have them, whether it's a daily dashboard you look at that's telling you, okay, number of customers, revenue, customer acquisition cost, whatever your key KPIs are, so that when you speak to me as an investor, any question I have, you should be able to answer. Now, what does that tell me? That tells me you really know your business. That tells me that you are data driven in terms of how you make decisions. And that gives me a lot of confidence, because that's really how, like, it's the advantage you have as a startup, is that you have far greater access to data and control of data than a traditional business. As you're operating online, you should, in theory, have almost complete visibility if you can build the right systems and processes. So if I see that, and how do I test that? I ask you questions around your numbers. If you're clear on them, then that gives you, okay, this is someone who understands their business well, has the right systems and processes in place. If you and ah about core information about your business, it makes you, to me, it makes you look unprofessional. That you're, and I get it, you've got a lot of things going on. You're constantly putting out fires. Nothing is working how you were expecting it to work. But it's all the more important in that situation that you know the numbers and what's going on in the business. Otherwise, you're just sort of crashing around in the dark, trying to find the light switch, and that would unlikely and usually ends up with things getting broken. The final couple of things for me, and I've talked for longer than I wanted to, but hopefully been helpful. So the point number 8, if you're going to an event, really think about maximizing your ROI from that event by planning beforehand. So if you're going to an event and there are a few VCs that are going to be there, look at those VCs, do that due diligence, and try to get in touch with them beforehand. Try and make sure they've seen your deck. Try and not necessarily set up a call, but just to send them some information. So they can be, the ideal situation for you is they go, oh, really interesting. Let's organize a time to meet at the event. But chances are they're going to be busy. But at least if they've seen you, you go up to them and said, oh, you come up to me, you say, hey, Robin, I sent you a deck. I'm the company doing ABC, like your portfolio companies, XYZ. And it would be great to, if you got 5 minutes, I'm going to remember. I'll be like, oh yeah, I remember you got in touch. I had a flick through your deck. Let's take 5 minutes. By getting in touch beforehand, whereas if you just come up to me at the event and out of the blue pitch me for 3 minutes and then we kind of walk away, it's going to be very difficult for me to remember, because there's another 6 people that are going to do it immediately after you. And then I'm going to be speaking about things, whatever. So it's by preparing me, priming me as the VC or anyone else that's attending the event, you're increasing that chance that I'm going to remember, and then I'm going to then be able to ask you interesting questions, and then maybe say, okay, let's follow up. Here's my email. Get in touch afterwards. The final point, and this I think is a very important thing, because when you're fundraising and you keep being told sort of no, not quite, I'm not sure, I think it can be easy to, or it's maybe natural to doubt a little bit what you're doing. Like maybe investors keep questioning this one thing, and you do have to take that advice. You do have to listen to what investors are saying to you. I mean, that ability to take feedback and onboard it and implement it where it's relevant is a very powerful skill. But at the same time, don't let investors drive your business, because in the end, it is your business. You're the one who's operating it. And investors have their own preconceptions and ideas that they have for a whole bunch of different reasons, like not necessarily correct for your business at your point in time. So if you're getting feedback from an investor, they're saying, oh, we don't really like how you do this. Okay, maybe they're right. Maybe they are right, and it isn't something you thought about, and they have this experience. But maybe they're just biased by their own prior experience. Maybe it was a negative experience, and they don't actually really they haven't really taken the time to fully understand. So stay true to what you believe in. You know the problem that you're trying to solve. Now, how to solve it will not be clear yet, and you may not have found that sort of product market fit, have really identified, truly understood it. But it is very important that you stay true to what you believe in, because long term, I think it increases the chance of you actually succeeding as a business. And if you have found the right investors, you've done the due diligence on them, you've built the relationship, you've got them on board, and they really also believe in what you're doing, then you have a kind of a champion that will support you and through when times are tough, help you in strategic ways with fundraising, and does so very much from being on your side, rather than someone that you've kind of, both of you have sort of changed things in order to make it work, and no one is really quite happy. So those were the kind of things that I wanted to run through in terms of advice. I thought I'd finish with another kind of Game of Thrones reference, in that, yeah, like it definitely is more difficult to raise money at the moment. Like that sort of funding winter is here, but I kind of like I thought it was a bit cheesy, the analogy, but the sort of the IS Stark, the sort of the small plucky one that you wouldn't expect ultimately being the one that sort of saves everyone. And I think that's true of a lot of startups. It's like in the end you are the plucky underdog, the one that really probably no one does expect to succeed. Maybe like certainly not the kind of the bigger businesses, the incumbents, a lot of the people you know, maybe friends and family think what you're doing is crazy. But I think that kind of that dedication, that hard work, that investing in not only the business but yourself and your team on really making sure that when you are fundraising correctly and in the right fashion. Ultimately, hopefully you're not sort of going around stabbing people, stabbing Night Kings, but you do come out, you can come out on top in the end. I think now is actually a great time to be building technology businesses. I think there are across Central Asia and across emerging markets, so many inefficiencies in the way that businesses and consumers go about their day-to-day lives. Those inefficiencies can be solved with technology. In the current environment of higher inflation, of squeezed kind of real incomes, disposable incomes, people's propensity to adopt new technology is higher because the marginal benefit or saving that you're providing them is greater. So therefore, that now being a prime opportunity to build businesses, build technology startups, and that can also scale in how they solve problems in a way that traditional businesses can't. So on a more kind of hopeful note, I think now is a fantastic time to be building a startup. We as Sturgeon Capital are actively investing across Central Asia and the Caucasus, as well as Pakistan and Bangladesh. So like I said, you know the best ways to try and get in touch. Try and get in touch with any VCs. That really I think is the right way to go about doing it. And that is enough of me talking for now. I'll leave this on the screen because I kind of like the image.
Yeah, thank you for that, Robin. I think that's quite insightful. We have a couple of questions already in the Q&A box. So we have one from Ilgar from Azerbaijan, Baku. He's asking if investors are happy to invest in companies that are competitors of portfolio companies. So would you as an investor be looking to diversify, or you wouldn't mind investing in competing companies with existing portfolio companies?
So generally as a point of principle, we will not, and VCs will not invest in direct competitors, because you have a finite amount of money, finite amount of resources that you can kind of allocate to startups and to helping startups, and to invest in competitors really makes no conceptual sense or like logical, rational sense. You should, and this I think is sometimes where, like, if you're a founder and you're speaking to a VC, if you're reaching out to them and you can see that they are invested in your direct competitor, it's pretty unlikely that they will invest in you. But also, I think what people may think superficially that companies compete, but actually underneath, when you kind of dig into it, that actually they're not direct competitors. Maybe they could actually be potential for collaboration. So if you see a VC that has a similar portfolio company to you and to what you're doing, really like look at it and try and understand, are you competitors or not? And if you are, if you are direct competitors, it's probably not going to happen. But maybe you're complementary. Maybe actually there are ways you could work together. And maybe I'll still take a call with someone that may be a competitor, and I'll say up front, it's like, look, we're investors in this business, so the stuff you don't want to tell me, I totally get it, but happy to kind of hear you out, and maybe I have some ideas. Maybe there's something we can do together anyway. But yeah, broadly, the answer being no, investors will not invest in direct competitors to existing portfolio companies.
Perfect. Thank you for that one. We have another question from Huma from Pakistan. Huma is talking, well, they have a business that is revolutionizing the booking experience customers experience for salons and aesthetic clinics. And she's asking, number one, what expectations do investors have for early stage startups who have a small traction? And the second is, what is the expected timeline for securing investment from initial pitch to closing the deal?
Okay. On the first question, what expectation investors have for early stage startups who have only have a small amount of traction? Well, if you're at that idea stage, what do investors want to understand? They want to know, why are you the right person to be solving this problem? So I think sometimes people, and I see this particularly in kind of first-time founders or idea stage companies, where they put the team slide right at the back of the presentation, and it basically just has a couple of photos and some names. That is useless. Like, that, for me, that is completely useless, because like I want to know, why are you the right people to solve this problem? Like, especially if you are idea stage, so you haven't got traction, you can't prove you're good at what you're doing through the numbers that you have. You have to show to me why, okay, this is a very complex problem. It is a significant problem. And this is huge. Telling me it's large enough that we can build a big business. It is something that people will care about and they will pay for. And we are the right people because of the experience we have, either at startups or in the relevant industry or whatever the reasons are. Put that right at the front of the deck, because that, especially if you don't have very much traction, that's what you're selling me on. Once you start having more traction, that team is important the whole way through. But once you start having traction, then I'm also looking at that, and that kind of ties into it. The traction, if anything, becomes evidence for what you're claiming in the section where you're talking about how kind of why you're the right team. So that I think is probably the main one, as I said, kind of showing and demonstrating this is a significant problem, that it's a big market, that people will be willing to pay for it. And one advantage you have if you're building, say, a business in Central Asia, is there is probably someone else or there's probably a company in Southeast Asia or India or Latin America or maybe Africa that has already done what you're trying to do, and maybe they've already been successful. Like, maybe they're now a sort of few $100 million business, maybe they were acquired, whatever it may be. And I think and this is true at any stage as a business, but if you can point and say, this is, and maybe what you're doing is completely novel. If it is, then that doesn't count. But chances are you're building something that someone else has already built elsewhere, and you're doing it for your market. And you can look and say, look, these are the type of companies that have already been built. We've fully understood how and why they were successful. This is why we think we will be able to do it in our market, what we will have to do differently, and why. Putting that in there, I think is very compelling, because then as an investor, I can go, okay, so this business model works. Okay, interesting. Now I come back to, well, are you the right people? And that's why that sort of team page is so important. But so sort of team, kind of, can this business model work? Does it work? Problem size, market size, and kind of, are people willing to pay for it? But at idea stage, you are a lot of times selling people more on the emotional sort of side of things rather than the sort of data-driven side of things. So it's selling your story, and that includes your team as well as the problem. What was the second question? It was, what is the expected timeline for securing investment from initial pitch to closing the deal? I don't know if you know the phrase, how long is a piece of string? But it massively varies. If you're talking from literally the first time you ever speak to that investor, it could be years, because maybe you're pre-seed and they invest at seed. So maybe it's 12, 18 months down the line. But when if you're pitching someone at the right stage for them, your business is at the right stage to actually be able to raise that money. I would expect anything from 1 to 6 months. And it will take longer the more money you're raising and the more developed the business is, because the more due diligence that will be required. But that would be kind of at a sort of high level what I would guide.
Perfect. I think we have another question from Lutfullah, and he is asking that as a startup, I believe that I'm true to myself, but as an investor, how would you judge that?
It's a good question. I mean, when you, I mean, that's something that you probably demonstrate during the conversations you have with investors. So like when you first speak to an investor and you say, look, this is what I want to do, an investor will question why you want to do it, how you want to do it, is it the right way, is it not? So you'll get questions. And I think you demonstrate it by being able to respond to those questions clearly, to articulate your vision, and to not sort of just, if they say, oh, we're kind of interesting if you did this, and you go, oh no, okay, absolutely, yeah, we can do that, we can do that, because then it just sounds like you're trying to please me rather than trying to sort of actually really build your business. So I think you demonstrate it during the due diligence process, in how you interact with the investor, how you present your information, how you respond to questions, and ultimately sort of over time showing that yes, this is something you really believe in, and that you're not necessarily willing to, you're able to take advice and feedback, but that you're also kind of committed to building this business how you believe it should be built.
Perfect. Thank you for that. Then we have a question from Angel, who's asking that when they're pitching to investors, they're normally asked if they've raised money before. And if the startup has been bootstrapped, does that decrease chances of raising investment?
No, I mean, look, I think it's generally true that actually for a lot of businesses, venture funding is not the right funding, because my money is expensive. Not only do you give up equity in the business, but my money is expensive because remember, I have like Sturgeon Capital has its own investors, and we tell our investors that if you give us X amount of money, we will deliver 5x that over the lifetime of the fund. Now, what does that then mean is that, well, each investment I make has to be able to grow to a significant enough size that I will make enough money if that business exits to return to my investors. So, and I think this is particularly true, I think sometimes with kind of first-time founders, or if it's your a kind of just a sort of smaller business, is actually if you can minimize the amount of funding you raise. And it's an open question, like what sort of entrepreneur do you want to be? Is this your one business? Is this the only thing you care about? Like this is all you want to do and you're going to build it forever? Then okay, that's maybe a different thing. But if you want to be a serial entrepreneur, realize that, okay, you're probably going to have a couple of businesses that go wrong, a couple of businesses that sort of kind of do nothing, and maybe one that goes really well. But if like your first business, you build over a couple of years, you bootstrap, it's kind of a profitable business, and you sell it for 500 grand, and you own 100% of that business, along with your co-founders and the team. Fantastic. That's cash straight into your bank account. You go on and do the next business. Now you have experience and a bit of money. Maybe you bootstrap that one for a bit, and then you raise a small amount of angel money, and then maybe you sell that business for a couple of million. Fantastic. Again, great money for you. Your angel investors are happy. You've now got 2 successful businesses. And when you go to investors, they'll be like, oh, wow, like this is someone who really knows what they're doing. They've got experience. And I'm not having to give you money to make mistakes. You've already made them kind of on your own, and now you're in a much stronger position. So is bootstrapping a bad idea? No, I think it's a fantastic way of building business. The one thing I suppose is, like, if you've never interacted with VCs before because you've always bootstrapped, it can be difficult. And I know, like, it's not necessarily obvious what VCs want to hear. So if you have bootstrapped and you've got to a certain size and you're kind of fundraising for the first time, then I would say kind of try and speak to other founders who have raised money and understand, like, what is it that VCs expect? Because what you think is important may not be the same as what they think is important. And so just to make sure that you don't go in presenting things the wrong way around. But no, I mean, I think if you have managed to bootstrap and you've got it to a sort of significant size, and well done, I mean, fantastic. Can you keep on bootstrapping? Maybe. I mean, there's a business I know in Pakistan called Cloudways that was acquired for 350 million, having never raised any external capital. So you can do it. Like, you can do it, and for you as a founder, the monetary return will be even higher because you won't have sold any of your business to investors. But it kind of very much varies company by company.
Perfect. And then we have a question from Sachdev, who's asking if there are any obvious sectors for scalable startups in Uzbekistan, given that that the economy is rapidly modernizing across various sectors. What may be some low-hanging opportunities or sectors that one could look at?
It's a good question, and we've made 6 investments in Uzbekistan directly, as well as we help manage the government's UzVC fund that has now made 6 investments as well. So we have a pretty good sense of the kind of the economy and the sort of the opportunity set. What is good about Uzbekistan in terms of building startups is, as you say, it's coming from a very low base, rapidly digitalizing and modernizing. So there's a lot of, if you like, open space for startups to build without incumbents or foreign competition, which is good. You also have a large population. So the kind of local economy, the local addressable market is, I think, big enough in and of itself to build consumer-facing businesses. Although consumer businesses are difficult in markets where the level of digitalization is still low. You also have a diversified economy. So it's not dominated by just natural resources or oil and gas. You have some oil and gas, you have some natural resources, but you also have a large agricultural sector, you have a large services sector, you have a large, tourism obviously coming within that. Pharmaceuticals is a large sector. And that I think means there are a large number of areas. I think agriculture is one that broadly hasn't really been touched much yet, although I think I saw the founder of a company that we're invested in that operates in Uzbekistan in the agri space. So there are a couple of people tackling it, but I think that's a kind of an area where there's a lot of opportunity. The difficulty you have is that typically farmers anywhere in the world are not the most technologically savvy or the easiest people to get to adopt technology. So there will be a lot of education that's required to demonstrate value in this sort of thing. But I think if you look at agriculture, financial services, generally the more kind of services sector, tourism, and in the end as well, the advantage you have in Uzbekistan is, and it's true of kind of across Central Asia, courtesy of the Soviet Union, that sort of shared history and language, but also kind of going back further than that as well, sort of with the Silk Roads and trade, that these regions have, like, it is a region that you can think of not as a whole, but as being well connected, that you have the opportunity to expand from Uzbekistan to Kazakhstan to Kyrgyzstan to Tajikistan. So I would never just think about Uzbekistan. Uzbekistan is where you start. It's your home market. You test your product. You build out that kind of product market fit, but always having that opportunity as well, that if you're successful there, that you can expand across the sort of Central Asia region.
Yep. And there's another question which is from Syed Hassan. So how can you attract for short-term investors for project investment of maximum 60 to 90 days? What would be the ideal sharing?
That's a very different kind of investor that you're looking at. That's almost more of a kind of, like, in theory, that should be what banks are doing, is those kind of maybe short-term project-based loans or microfinance institutions, rather than maybe private investors might, maybe corporates might, with if they have excess cash flow. But to be honest, that's not really a sort of a VC thing. It's more, it should be banks, it should be microfinance institutions, and maybe some private individuals as well.
Perfect. And I have actually one question from my side. So given how the world is sort of shifting, not just economically, but also from social and environmental perspectives, how important do you think for a startup or a growing company to sort of quantify their impact? How much importance do VCs really give to that, if at all?
Well, so we do. We have 3 kind of core pillars to our impact sort of strategy, which is creating employment opportunities, supporting financial inclusion, and gender. So for us, it's a very important thing, and I think in order to build sustainable long-term businesses, having impact at the core of what you do helps significantly, because in the end, if you're solving a fundamental problem that affects the day-to-day lives of businesses and consumers, you will be having a significant impact on those day-to-day lives. And you should be looking to thinking of, if you can think about it, I don't know, we have investments in a few sort of lending businesses, fintech lending businesses. And with them, it's like, well, how many of those people you're lending to have never borrowed from a financial institution before? Because for them, you're bringing them into the formal financial sector. That will have a massive impact on their lives in terms of the opportunities that it can open up for them. And so we work with one of our portfolio companies is like, well, can you lend to 1 million people who have never borrowed from a financial institution before? That is a kind of North Star metric. Now, if you lend to those 1 million people, think about that, what that will mean in terms of kind of revenue that you will be generating. Kind of if you have a business model that makes sense, the profit you'll be generating, you will be a successful business financially, and you will have had a significant impact. So for me, and like on a kind of personal level and on a fund level as well, we look for businesses that are having an impact. And I think if founders are driven by really trying to solve fundamental problems, the businesses they are therefore kind of building as a result, the long-term sustainability and ability to capture the opportunity set is greater. So I like to see founders that are thinking about that. Now, obviously, it has to be a business model that makes sense. It has to be a problem that is big enough. Like there are these other considerations. But yeah, I think seeing that impact at the core of what founders are doing, certainly for us as an investor, and I think for a lot of other investors, increases the investability of the company.
And I think Lutfullah has another question. He's trying to understand what's the main psyche of an investor. Like if you had to profile them, what would it be like?
I don't know. I mean, they're as wide ranging and as weird and as wonderful as founders are. I mean, you try and sort of pinpoint the psyche of a founder is also equally difficult. Many, I don't know, like you get some investors who were founders before, so have a very kind of operating mindset. You get others who come from a very financial background. You get some who've been journalists. I mean, myself, I was like a historian linguist, so I didn't come from a financial background. Like it's very different, and I don't know. How can you figure out? Like, go on their LinkedIn, maybe listen to some podcasts or they've done or articles they've written. Maybe that'll give you a sense of what sort of thing is important to them, what isn't. But yeah, they're as varied as you are as founders.
Thank you for that, Robin. So everybody who's attending, we still have about 5 minutes to go. So if there's any burning question left, maybe Robin can take one more question before we close the discussion. And if there isn't, then yeah, I don't think there are any other questions coming in, but Robin, thank you so much. This has been really informative. And I think very practical, so to say. So it's not really, like maybe not a lot of hard work that goes into it, but maybe more of how forthcoming you are or honest you are about, what you're doing and how you're really building it up, that has to come across. So I think for me today, I personally got a lot out of it, and I hope so much for the participants as well. And we really appreciate that you made time and did this for us. So we'd love to sort of
thank you very much.
We'd love to sort of keep in touch. And definitely, what I would like to do for all the participants is we'll circulate a sort of a feedback form where you can share some feedback about the session, as well as highlight other topics that you'd like to hear on, that you would like to have some speakers come on, and we try to organize that. So thank you to all the participants for being here and for sharing their questions. And I mean, it was a great discussion, although it was a webinar format. It was still really good questions that came across. So I always enjoy things like that. So thank you, everyone. Have a great rest of the day, morning, afternoon, or evening, wherever you all are. And we'll see you for the next webinar once we've planned that out in the next month.
Thank you very much, Hira. And thank you, everyone, for joining.
Thank you. Bye-bye.
Cheers. Bye.
Yes, bye.